Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about the Coca-Cola Company annual report. The Coca-Cola Company offers a diverse range of beverages to consumers worldwide. At the heart of its product line are sparkling soft drinks and flavors, including iconic brands such as Coca-Cola, Diet Coke, and Fanta. The company also provides still beverages like water, sports drinks, coffee, tea, juice, dairy products, and plant-based alternatives. In addition to these core offerings, Coca-Cola sells beverage concentrates and syrups to fountain retailers, which include restaurants and convenience stores. Its portfolio of brands is extensive, encompassing over 20 different labels such as Sprite, Simply Orange, Fresca, Schweppes, and Thumbs Up. The company operates through a complex network of independent bottling partners, distributors, wholesalers, and retailers, allowing it to reach customers across the globe. Coca-Cola's product line also includes value-added dairy products like Fairlife and Minute Maid Pulpy, as well as plant-based beverages such as BODYARMOR and ILOHAS. The company has expanded its offerings in recent years to include premium brands like Costa Coffee and Topo Chico Sparkling Water. With a presence in over 200 countries, Coca-Cola is one of the largest beverage companies in the world. The Coca-Cola Company's stock price has experienced a significant increase of over 16% in the past year, driven by several key news events and strategic developments. One major contributor to this growth was the company's strong financial results and positive outlook. Coca-Cola consistently delivered robust earnings reports throughout the year, with net revenue increasing by approximately 2% year-on-year and organic revenue growing by 5%. The company also raised its full-year 2025 comparable currency-neutral EPS growth guidance to about 8%, further boosting investor confidence. Another factor contributing to the stock price increase was Coca-Cola's consistent commitment to shareholder returns. The company demonstrated this through its 64th consecutive annual dividend increase, raising the quarterly payout from $0.51 to $0.53 per share, a 4% increase. This move not only provided a boost to investors, but also signaled the company's confidence in its future growth prospects. The appointment of Henrique Braun as CEO and the creation of a new enterprise role to accelerate digital transformation efforts also contributed to the stock price increase. These strategic leadership changes and focus on digital transformation signal a forward-looking strategy focused on operational continuity and data-driven execution. Finally, Coca-Cola's total beverage strategy and brand investments played a significant role in its performance. The company continued to prioritize zero-sugar soda offerings and functional drinks, with growth from its $32 billion brands contributing to the positive trajectory. Overall, these factors combined to drive Coca-Cola's stock price increase of over 16% in the past year. The Coca-Cola Company market capitalization of $343 billion is significantly larger than the average industry peer of roughly $5 billion. This shows that the Coca-Cola Company holds a significant advantage in their industry. The Coca-Cola Company trades at a higher price-to-earnings ratio of 26 times and a higher price-to-book ratio of 10.68 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 74% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The company have a dividend yield of 2.58%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for Coca-Cola between 2023 and 2025 can be attributed to several key factors. Firstly, the company's concentrate operations accounted for a significant 59% of net operating revenues, while finished product operations made up 41%. This indicates that the production and sale of concentrates had a substantial impact on revenue growth. Another crucial driver was the geographic segments, particularly the EMEA, Europe, Middle East, and Africa segment, which drove revenue growth through the cost of business. Additionally, key customers played a significant role, with one bottler accounting for 10% of net operating revenues in 2025. The impact of foreign currency exchange rate fluctuations also cannot be overstated, as losses recognized in other comprehensive income, OCI, affected net operating revenues. Furthermore, derivatives used to hedge against foreign currency exchange rate risks, interest rate risks, and commodity price risks had a significant impact on revenue growth or decline. While divestitures worth $2 billion impacted revenue growth, the overall financial performance of Coca-Cola showed an increase in net operating revenues, gross profit, and operating income between 2023 and 2025. The Coca-Cola Company's net income and profit margins have undergone significant changes between 2023 and 2025. In terms of net income, there was a slight increase from $10,703 million in 2023 to $10,649 million in 2024, followed by a more substantial rise to $13,137 million in 2025. This indicates that the company's overall profitability improved over this period. However, when examining profit margins, a different picture emerges. The gross profit margin decreased from 40.6% in 2023 to 39.7% in 2024, before increasing to 41.1% in 2025. Similarly, the operating income margin declined from 12.6% in 2023 to 12.2% in 2024, and then rose to 13% in 2025. These fluctuations suggest that while the company's net income improved, its profit margins experienced some volatility. The reasons behind these changes are not explicitly stated in the provided text. Nevertheless, it is possible that the company implemented cost-cutting measures or optimized its operations to boost profitability and offset declining profit margins. Further analysis of the company's financial statements would be necessary to fully understand the underlying factors driving these changes. The company's financial performance indicates a consistent trend of generating positive operating cash flow. According to various summaries, the company has successfully received significant amounts from selling trade accounts receivables under a factoring program in 2025, totaling $14,710 million. This is further confirmed by subsequent pages, which explicitly state that the company generated positive operating cash flow in all 3 years of 2023, 2024, and 2025. The specific numbers provided for operating cash flow also support this conclusion. In 2025, the company reported an operating cash flow of $11,010 million, while in 2024 it was $11,488 million, and in 2023 it was $9,692 million. These figures demonstrate a steady increase in positive operating cash flow over the years, indicating a strong financial position for the company. The company's debt level and interest expenses have undergone significant changes over the past year. Initially, long-term debt decreased from $8,752 million in 2024 to $673 million in 2025 on page 57. However, this trend was reversed as it increased significantly to $42,623 million by page 59. The current maturities of long-term debt also saw an increase from $648 million in 2024 to $1,822 million in 2025. On the other hand, interest expenses have remained relatively stable with some fluctuations. On page 52, it is mentioned that interest expense decreased by only $2 million from $1,656 million in 2024 to $1,654 million in 2025. However, on page 55, interest expenses increased from $77 million in 2024 to $217 million in 2025. The overall debt level has seen some variations, with an increase of $92 million from December 31, 2024 to December 31, 2025, page 80. The total debt also increased from $1,139 million in 2024 to $1,495 million in 2025. However, on page 97, it is mentioned that long-term debt decreased from $42,375 million in 2024 to $42,119 million in 2025. In conclusion, the company's debt level and interest expenses have seen significant changes over the past year, with some fluctuations in both directions. The performance of various segments and regions within the company has been mixed. On a positive note, North America has shown consistent growth, with no major issues reported. Latin America also performed well, despite some conflicting information regarding revenue growth. In contrast, certain regions have struggled. Florida's citrus greening disease and weather conditions have impacted orange juice supply, leading to poor performance. The USVI in California have been affected by a lawsuit filed against the company, further exacerbating their struggles. Africa has experienced mixed results, with a negative period from January 2021 to December 2020. Unfortunately, there is limited information available on several other regions, including Asia-Pacific Group, Greater China and Korea Business Unit, ASEAN Business Unit, and Europe, making it difficult to assess their performance accurately. The management of this company is signaling a shift towards a more streamlined and optimized business strategy. By actively refranchising bottling operations and divesting non-core businesses, the company aims to focus on its core competencies and eliminate unnecessary expenses. This move is part of a broader effort to manage risk and maximize shareholder value. In terms of revenue recognition, the company has adopted an incidence-based concentrate pricing model that aligns financial objectives with bottling partners. This approach allows for shared value creation and more efficient management of resources. The use of derivatives as a risk management tool also demonstrates the company's commitment to mitigating market risks such as foreign currency exchange rate risk, commodity price risk, and interest rate risk. The company is also taking steps to optimize its tax positions and pension plans. By modifying investment strategies for certain non-U.S. plans, the company aims to reduce funded status risk and improve long-term returns on plan assets. Additionally, the company has invested in limited partnerships that receive tax credits and other tax benefits, which is expected to generate significant returns. Overall, the management's strategy appears to be centered around optimizing the portfolio through refranchising and divestitures, managing risk through derivatives, and investing in tax-efficient investments. This approach is likely to position the company for long-term success and growth. The company has undergone significant acquisitions and divestitures over the years. In terms of acquisitions, the company has invested in various assets such as public equities, long-duration bonds, hedge funds, reinsurance, private equity limited partnerships, and real assets. Additionally, there have been plans to acquire or lease additional facilities and dispose of existing ones. On the other hand, the company has also divested several businesses and brands. The Global Ventures operating segment was sunsetted, and Costa's ready-to-drink business was moved to its applicable geographic operating segments. The company has also refranchised its consolidated bottling operations and sold certain brands or businesses. Furthermore, there have been significant divestitures in 2024 and 2025, including the sale of trade accounts receivables worth $21,873 million and $14,710 million respectively. These transactions resulted in a decrease of approximately 18,000 employees in 2025. The company has a history of paying dividends to its common stockholders, with payments made quarterly since the past. In 2023, it paid out $420 million in dividends. The amount increased significantly in 2025, with $8,779 million being distributed to shareholders. In addition to dividend payments, the company has also been actively buying back shares. In 2025, it repurchased 9.4 million shares at an average price of $67.42. This move is part of a long-term strategy to use excess cash to reduce its share count and increase shareholder value. The company expects to continue this practice in the future, with plans to repurchase more shares in 2026. Concerns about inventory buildup or supply chain disruption are indeed present in the industry. Adverse weather conditions and geopolitical instability can impact supply chains, leading to logistical and transportation disruptions. Page 8. Manufacturing operations and supply chains may also be affected by shortages of raw materials and supplies, limited suppliers for certain ingredients and packaging materials, and adverse weather conditions affecting agricultural commodities. Page 14. Furthermore, potential disruptions to supply chains due to strikes, work stoppages, or labor unrest at bottling operations or manufacturing facilities are a concern, page 15. Indirect taxes, changes in laws and regulations, and labeling or warning requirements may also impact the supply chain, page 20. The data shows that raw materials and packaging inventory increased by $86 million from 2024 to 2025, page 72, indicating potential issues with inventory buildup. While these concerns are not specific to the company's operations, they do highlight general risks in the industry. Addressing these challenges will be crucial for companies to maintain a stable supply chain and mitigate potential disruptions. That concludes the financial summary for the Coca-Cola Company. Feel free to comment below, and I will be happy to answer them when possible.